Welcome friends, welcome to the course of international business. In the last lecture we had discussed about the export promotional measures, and for example we talked about the export promotional schemes, right. How the government tries to undertake various schemes like the duty drawback scheme, export finance scheme, and then we talked about the various organizations involved in the export promotion in India. For example, the IIFT, for example, the ASSOCHAM, and then the DGFT, right. So we talked about the various organizations and various schemes in the last lecture. Today we will talk about the different institutions, the economic institutions in the international scenario, which are involved in international trade, not only in trade, but also they have a large influence on the monetary and economic condition of a country, right. So, they are not exactly a part of the international business scene, but they have a importance on the economy as a whole. For example, let us start with the first one, as it says almost every country exports and imports products to benefit from the growing international trade. The growth of trade can be increased if the countries follow some common rules, right, regulations and standards related to the import and export. So, that is the reason why the World Trade Organization tries to talk more about globalization, so that and liberalization, so that the economies open up more, and then they would all be benefited. So, in order to have those growth in trade and business, some rules and regulations are specified. These rules and regulations are set by various international economic institutions, right. These institutions aim to provide a level playing field, so that nobody takes advantage of it, neither strong countries exploit the weaker ones, which is generally the fear for against globalization, right, that large strong countries will take more advantage and the weaker countries will get exploited, that is the fear, right, and develop economic cooperation, right. So, among when we talk about these economic institutions, so the major international economic institutions, we will start today when we talk about it. We will first talk about, before we get into any institution for that, we will talk about the Bretton Woods agreement and system, right. What is this Bretton Woods agreement and why we are discussing today? This is an agreement which was negotiated during the World War II time, right, as you can see during the World War II. And it was established as a new international monetary system for creating an efficient foreign exchange system, right, preventing competitive devaluations of currencies and promoting international economic growth. So, after the World War, what happened was many economies had got affected. So, some of the allied countries, they wanted to come together, and there were 44 nations in together, as you can see here also. So, 44 nations who came together to set up a monetary system, right, and they felt this monetary system would help in smooth transaction of business and trade. So, it was held in Bretton Woods, right, and 730 delegates came here, which is also called as a Bretton Woods conference, right. Largely influenced by this Bretton Woods agreement was largely influenced by two people, right. The ideas of one was John Maynard Keynes, his idea, and the other was the chief international economist of the US Treasury Department, Harry Dexter White, right. These two people had a significant influence in making this Bretton Woods agreement system. What was Keynes thought? Keynes had desired to establish a powerful global central bank, which would be called as the clearing union, and it would issue a new international reserve currency called the banker. This is what Keynes had wanted. On the other hand, White's envisioned a modest lending fund and a greater role for the US dollar, right. So, instead of creating a new currency and all that, like the banker which Keynes was thinking. So, White thought we will be more of a create a lending fund, right. In the end, what happened? The adopted plan took ideas from both, but it was more leaning towards White's plan. That means, a new currency was not adopted, but more of a funding approach was made, right. Under this agreement, the US dollar would be pegged to the value of gold, right. What was the condition? The US dollar, and that is at that time, if I am not wrong, $35, right, were pegged against 1 ounce of gold, 1 ounce of gold, right, during the start, and then the other currencies would be pegged against the US dollars value, right. So, this is how it went. So, the gold was pegged, the dollar was pegged against the gold, and the other currencies were pegged against the US dollar, right. But this came to effectively, if this system started, although in 44, in 1944 they joined, it effectively started working in 1958, right. But in the early 70s, when Nixon came into power and was the president of America, Richard Nixon, very famous for the Watergate scandal, right, announced that the US would no longer exchange gold for US currency, right. So, that is where the Bretton Woods agreement came to a stop, but this great agreement, or you can say this initiative which was taken, had a wonderful influence because they created two institutions out of it. One, as you know, very popularly called the IMF, International Monetary Fund, which grants short term loans to develop the cyclical disturbance in economy. We will deal with it later on. And then the World Bank, which gives long term loans for distressed economy, right. So, this is how the whole things started. So, now let us move to the first one, the two bodies after the Bretton Woods agreement was over in 70s. So, when the IMF was built, what is this IMF and how, what is its major roles? The IMF was to promote international monetary cooperation, right. The whole idea was to promote international monetary cooperation, and it has played a vital role in maintaining global economic stability and ensuring broadly shared prosperity. So, it talks about prosperity as a shared principle. So, everybody grows. It is an organization as of today with 189 countries working to foster. So, these are some of the major objectives of the IMF: to foster global monetary cooperation, secure financial stability, facilitate international trade, promote high employment and sustainable economic growth, and reduce poverty around the world. So, these are some of the objectives of the IMF, right. The IMF's the purpose was to monitor exchange rates and identify nations that needed global monetary support. So, suppose some country was in a monetary distress or a fiscal problem. So, it is IMF who goes into the as a savior, right. It aims to promote the global economic growth and financial stability, encourage international trade and reduce poverty, as I have written already. It is based in Washington DC and 189 members are there. So, these member countries have representation on the IMF's executive board in proportion. This is very important. The member countries, so there are 189, these member countries have representation on the IMF's executive board in proportion to its financial importance in the global trade or something, right. So, that the most powerful countries in the global economy have the most voting power, right. Okay. Now, let us deal with the role of IMF. So, let us discuss in detail. So, the first prominent role is that it plays the role of economic surveillance. Now, what does it mean? In order to maintain stability and prevent crisis in the international monetary system. So, you must have heard of several crises which have happened in the past. For example, 29 there was the Great Depression, 2008 there was a the subprime crisis. So, in 29 IMF was not there obviously, but the point is whenever there was a crisis, an economic crisis around the world, 1998, 99 Southeast Asian crisis was there. So, whenever such crises have occurred, the IMF immediately comes to the rescue of these nations, right. So, in order to maintain stability and prevent crisis in the international monetary system, the IMF monitors member countries' policies as well as national, regional and global economic and financial developments through a formal system known as surveillance. What is saying? It creates a formal system to keep in check the policies of the various countries, the regions and the global economy as a whole. It employs a number of economists, right, to track the health of its member countries. So, there are 189 member countries. So, it employs a large number of economists to take to keep track of the economic health of these countries, right. The discussions focus on economic policies like exchange rate, monetary policies, fiscal policy, regulatory policies, in addition to the macroeconomic structural reforms. Now, so what do you mean by structural reforms? Structural reforms are basically the the let us say the banking reforms, or the kind of policies which have a structural effect, right, or makes a structural change. So, for example, what are the NBFC policies, what are the bank policies, how to govern banks. So, these are things, and other policies contributing to a nation's stability and growth. It also provides periodic assessments of the global prospects in its world economic outlook, of financial markets in its global financial stability report, of public finance developments in fiscal monitor, and of external positions of the largest economies in its external sector report, in addition to a series of regional economic outlooks, right. So, this is the first role of the IMF. So, let us look at a case which I have brought. So, how Vietnam is a classic case, which in the 1980s or the early 80s it went through a very difficult time, right. This country, one of the world's poorest, was still recovering from the decades of war. Vietnam, US Vietnam war, I think it is very popular. So, most of the people must have heard the Vietnam war, right. So, it was still recovering from the war. Its centrally planned economy was unable to deliver basic consumer goods. So, the country was in a bad state. Inflation was running at 400%. The cities were regularly darkened by power cuts. So, this was a very bad scene. Things began to change around 1986 with the start of an ambitious program known as Doi Moi, or renovation in their language. Within a few years, Vietnam people had television sets, washing machines, consumer goods, right, which developed, and people, there were a lot number of businesses springing up. The private enterprise flourished and foreign investment flowed in. Vietnamese started to travel abroad and joined the global economy. How it happened? Advisors from the IMF helped Vietnam improve public administration, tax policy, central banking, and statistics gathering. IMF assessments of the economy helped Vietnam improve its credit rating also, which drew foreign investment. And one of the in this remarkable journey, it from low to middle income status, 40 million people were lifted out of poverty, right. So, Vietnam's remarkable journey, it says, from low to middle income status lifted 40 million people, right, out of poverty between 93 and 2014, right, almost in a span of 21 years. In this time span, the poverty rate dropped to 14% from 60% almost. Vietnamese are now better educated and expect to live longer. These are all indicators of a good economy also. So, almost every household has electricity, up from less than half in 1993, right. In 1980s, the country was in dire economic states. As I said, job number one was to stabilize, what the IMF had to do was to stabilize the economy, which meant easing price controls, raising interest rates, limiting subsidies to inefficient state owned enterprises, and devaluing the Vietnam's currency. So, these are some of the problems. So, the IMF had to take care of these problems, stabilize the economy, ease the price controls, right, raise the interest rates were rising. So, that had to be controlled, subsidies were too much. So, that has to be again, and the Vietnam currency was devaluing. So, the dong basically, right, all these things had to be taken care of, right. So, the country transformed with the help of the support of the organizations like the Asian Development Bank, the World Bank, and the IMF, right. Finally, Vietnam went through a very good time, and it was able to attract companies like South Korea's Samsung and all these kind of good companies, and in fact, the local companies in Vietnam also are doing pretty well today, right. So, you can see a sea change that happened just because of a good intervention of the IMF in case of Vietnam, right. Second role of the IMF is to assist in financial assistance or lending. Now, what does it mean? The IMF assists countries hit by crisis. So, if there is a country hit by crisis, it provides financial support to create breathing room as they implement adjustment policies to restore economic stability and growth. It also provides precautionary financing to help prevent and insure against crisis. So, it provides finance against when in different kind of situations, suppose there is a serious balance of payment crisis, or sometimes due to some trade reforms the country is going through some trade reforms, and therefore it is it has been because of some certain reasons it has lost its ability to earn currency or revenue. So, all this time in this such situations the IMF comes and supports it for a time period, right. The IMF provides financial support for balance of payment needs upon request by its member countries. Unlike the development banks, the IMF does not lend. This is the difference what you can understand for specific projects. So, IMF and suppose for the example the World Bank, the difference is that the IMF does not lend for specific projects, right. Following such a request, an IMF staff team holds discussion with the government to assess the economic and financial situations and the size of the country's overall financing needs and agree upon the appropriate policy response, right. So, it is basically what it tries, it is it works like a elder brother who tries to understand the country's problem and tries to correct its problem with the help of its economists who have the knowledge about the particular country X, Y or Z, right. Some of the largest borrowers has been like Argentina, Ukraine, Greece, Egypt, and there are some of the precautionary loans which have been given to Mexico, Colombia, Morocco. Now, how does the IMF give loan basically, right? So, the IMF is basically a quota based institution. Now, what is this quota? So, when a country joins the IMF, it becomes a member country, it contributes a certain sum of money, right, which is called as a quota, right. So, and this quota is broadly based on its relative size in the global economy. So, it is not same for everybody, it depends on on your international size, basically trade size, right. Quotas are the building blocks of the IMF's financial and governance structure. An individual member country's quota broadly reflects its relative position in the world economy, as I said, and quotas are denominated in SDRs, basically special drawing rights, which is the IMF's unit of account. As of today, the combined total quotas value is 477 billion, or in terms of SDR, or US 661 billion, which you can take, right. Now, these are some of the multiple roles of quotas which have been shown in a diagrammatic form. You can see, for example, quotas determine the maximum amount of financial resources a member is obliged to provide to the IMF, right. Quotas are a key determinant of the voting power, right. The maximum amount of financing a member can obtain from the IMF is based on its quota. Quotas determine a member's share in a general allocation of the SDR, special drawing rights, right. What is this SDR? It is an international reserve asset. The special drawing right is an international reserve asset created by the IMF in 69 to supplement its member countries' official reserves, right. So far, SDR 204.2 billion, equivalent to 291 billion US dollars, have been allocated to its members, including 182.6 billion allocated only in 2009 during the global financial crisis, which is largely called as the subprime crisis also. The value of the SDR is based on a basket of 5 currencies. It was earlier 4, the fifth one has been recently going to be added. The US dollar, the euro, the Chinese, this one is the recent one, the Chinese renminbi, right, the Japanese yen and the British pound sterling, right. So, this is how the percentage of the SDR count goes, right. In the SDR basket, the basket consists of, so this 5, so US dollar 41.73, euro 30, the Chinese one or renminbi 10.92, Japanese 8.33, British pound 8.09. The value of the SDR is determined daily and based on fluctuations in the value of the currencies in the basket. So, this is how it has been used till now, allocated till now, right, that you can see later on also. Another case we will talk about. So, this was a case which happened in Ireland. So, Ireland its economy is largely employment is largely driven by construction industry. Its housing market was booming in 87 to 2007. So, you can understand this is the same period we are talking about the great the severe financial crisis which happened in 2008. So, but the extended boom times when during this time 87 2007 the country was doing pretty good, right. It was one of the very good economies, but when you are in a good time the things tend to go wrong from there. So, what happened with the extended boom times gave rise to private exuberance. So, people started spending money matched by complacency among banks. Banks were complacent, they were not working efficiently, and regulators making fertile ground for risky speculation. Now, they started making risky speculations which they were thinking nothing would go wrong, because in good times people are people generally think that nothing will go wrong. This is something like a we say this is an psychological effect that we have, that nothing would happen to me or nothing would go wrong with me, right. So, this is what happens. So, there was rising incomes and cheap credit, but in the decade ending in 2007 when property values more than quadrupled, right, swelling government revenue and generating income for everyone from bricklayers to bankers, but that is where the time came, and now the economy started going in the other side, on the bad side. The construction industry, which accounted for more than 12% of the employment, crumbled. Hardly any work was to be found in Ireland. Unemployment soared, and since the Great Depression gripped the country in 1929, since then this was now the biggest thing that affected them. Almost 3 lakh people, or 1 in every 7 workers, lost their jobs by the end of 2010. After a difficult period of adjustment, the Irish economy started growing again. The employment rate fell to less than 7% by 2017 from a peak 15% in 2011. So, that is not a small size, it is a huge size, right. The country's remarkable recovery is a story of cooperation between the Irish government and the IMF and the European Union. Ireland was swept in the global financial crisis, right, as we have seen, but its problems actually were homegrown. That means, the problems came from their own country, right. So, what was the problem? So, for example, what did the IMF do? And its return to economic health required homegrown solutions. So, what did they do? Restructuring of banks was done, putting government finances back on an even keel, and working out at a mountain of bad debts. So, all these things had to be corrected first. So, the IMF and the EU provided loans and advice. So, loans is only one thing which people think this is the loan, but more than the loan, the advice is equally important, right. But the Irish government took up was in the driver's seat and took the charge, right. In November 2010, Irish government sought help from the European Union and the IMF. Together they provided loans totaling 67.5 billion euros, equal to 40% of Ireland's economy, to be paid out over the next 3 years, right. And by the end of 2012, the second year of the program, right, the Irish economy began to turn around. So, it was again from a dark side time to a positive side they moved, right. Now, what are the IMF's lending facilities? We will discuss some of the lending facilities, right. So, the first one we will start by is called the standby arrangement, SBA. What does it mean? The SBA framework allows the fund to respond quickly to countries' external financing needs and to support policies designed to help them emerge from crisis and restore sustainable growth. All member countries facing external financing problem needs are eligible for SBAs subject to the IMF policies, and then the country repays the money over some time period, right. So, this is generally given this is a kind when it is given when the country is going through some kind of financial crisis. The second is flexible credit line. This is for countries with very strong fundamentals. This was started very recently. So, policies and track records of policy implementation. It has no ongoing conditions and no caps, there is no restriction on the size of the credit line. So, that is why it becomes very important that this flexible credit line is given flexible, and then is another called precautionary also credit line, which is given just as an insurance, basically kind of insurance, right. to countries with very strong fundamentals and policies. Then comes the RFI, which says the rapid financing instrument. It provides rapid financial assistance which is available to all the member countries facing an urgent balance of payment problem. So, this is also in all these things, most of the points it is the balance of payment crisis, right. Now, this is arising from commodity price shocks, natural disasters maybe, post conflict situations, some war like situations, and emergencies resulting from fragility. So, the RFI replaced the IMF's previous policy that covered emergency natural disaster assistance ENDA and emergency post conflict assistance EPCA. So, this was replaced with the rapid financing instrument. Okay. The next one is called EFF, Extended Fund Facility. When a country faces serious mid-term balance of payment problem because of structural weaknesses. So, structural are homegrown problems, generally the problems which because of some policy, wrong policies. So, banking crisis are happening, financial institutions are not doing well, everything is going wrong, right. One bank after the other is falling. That requires time to address. Now, this problem will require time to address, structural problems cannot be corrected very soon. So, the IMF can assist with the adjustment process under an extended fund facility compared to assistance provided under the standby arrangement, right, this one. Assistance under an extended arrangement features longer program engagement to help countries implement mid-term structural reforms. So, since these are structural reforms and it would take time, it would not be cannot be done easily. So, these loans are given, these facilities are given keeping that in mind generally for a long term period, and a longer repayment period up to 4.5 to 10 years is kept in mind, right, by the IMF. Another one is a trade integration mechanism which allows the IMF to provide loans under one of its facilities to a developing country whose balance of payment is suffering because of multilateral trade liberalization. Now, you must have heard about trade liberalization. So, either because of its export earnings decline when it loses preferential access, right. So, some countries have lost the preferential access. There was a for example, the multi fiber agreement. So, some countries were getting preferential access, then it was stopped, right, at one point of time. So, when you lose such kind of sudden advantages, so you do not get an advantage or the preferential access to certain markets, or sometimes because the prices of food imports go up when agricultural subsidies are completely eliminated. So, now the WTO pressurizes to eliminate the subsidies. So, in such conditions this to support the countries which have suddenly come to a shock because of such kind of changes in the trade in the mechanism. So, the IMF also gives loan, right, or money. 3 member countries such as Bangladesh, the Dominican Republic and the Republic of Madagascar have so far requested and obtained support in accordance with the TIM. Okay. There are 3 other types of loans also given by the this is for generally for the low income nations, this 3 for the low income countries, this is generally given. This was created under the new Poverty Reduction and Growth Trust PRGT for the low economic economies, low income economies, the extended credit facility, the rapid credit facility and the standby credit facility. So, these are some new kind of loans which have been made by the IMF to take care of the low economic countries, right. So, we will stop it here today because of the paucity of time. So, we will continue from here in the next session, right then. So, thank you very much.